And then the second reason is I have no idea how they can be growing as fast as they are and have as much exposure as they do without taking on a huge amount of risk with either their own investors' assets or their clients' assets. And we had this kind of debate about whether or not I was the right guy for the job, since I wasn't willing to do what they were doing to grow faster. And what they were doing, Celsius was a great example of this. They were offering yield on every single coin that had been minted, even though there was no way to generate yield on any of those coins without swapping them into something else, taking that risk that you couldn't hedge, and then swapping them into dollars and lending dollars, or swapping them into Bitcoin and lending out Bitcoin. But you couldn't hedge that risk that you had with the directional exposure. And they got badly hurt with that when everything started going down towards zero. And then the other thing they were doing is they didn't have any risk management procedures or policies around the credit underwriting they were doing for people like 3 Hours Capital. 3 Hours came to me 4 separate occasions asking to borrow uncollateralized funds. And I said, well, sure, let us do proper credit underwriting. Send me all of your financial statements. Well, they didn't share financial statements. And I said, well, we won't lend to you unless we can see financials. And they said, but we'll share an attestation of our assets under management. I go, yeah, I don't give a shit. I want to see your financials, because that means nothing to me that you've signed this piece of paper saying we've got $10 billion in AUM, because I have no idea what your net equity is. I have no idea whether any of those assets are yours. And so they kept saying to me, you're the only ones who don't lend to us in the space. And I kept thinking, we're going to be the only ones left standing when this all blows up. And it was less than a year later that all happened. So it really was, putting in the risk management, proper underwriting, proper credit underwriting, making sure that we weren't doing things with our clients' assets that they were unaware of. I think it's fine if you swap out clients' assets, if they want you to do that, if they want you to take that risk. But Celsius wasn't telling their clients they were doing that. They weren't transparent about what they were doing. And so we believe in transparency. We believe in protecting our clients' assets, and we put the client at the beginning. All the decisions that we make are client focused. And that's why we're around when they're not.
This episode of the Bitcoin Economy is brought to you in part by Ledn.
Need cash but don't want to sell your Bitcoin? Ledn is the global leader in Bitcoin-backed loans, issuing over 9 billion loans since 2018. And they were the first to offer proof of reserves.
With Ledn, you get custody loans, no credit checks, no monthly payments, and more. Visit ledn.io for more information.
Welcome back to the Bitcoin Economy. Today we have John Glover, CIO at Ledn, and Sean Risal, my esteemed co-host. And we're excited to jump into Bitcoin lending today. This is obviously a big focus of 21 Rates, what we talk about the Bitcoin economy, putting your Bitcoin to work with different Bitcoin financial services. So, John, welcome to the show.
Thanks very much. Happy to be here.
Yeah, John, thanks for coming on. Definitely excited to dive in. We were just talking before the show briefly. You have quite the background. I think that's actually, Jody, a great way to dive in. John, if you want to walk us through your journey, how did you get into this market? You were at places like Barclays, TD, and now you're the Chief Investment Officer at Ledn. What drew you into crypto?
So it's interesting. When I was at TD, so this is back in, I guess, 2013-ish, before I moved to the UK with Barclays. And I was presented with the white paper for Bitcoin, the Satoshi paper, and went through it with my tech guys, and we started talking about Bitcoin and what it meant, and did it have legs, and is this something that we should be looking at? And I am ashamed to admit that I was one of the guys who said, this is bullshit. This doesn't make any sense. It's completely fungible. There's going to be thousands of these currencies. They won't, none of them will have any utility. It doesn't make sense to me. So I didn't get involved. The bank, we didn't even put any efforts into investigating it. Fast forward to 2020, and I started having conversations with the co-founder of Ledn, Adam Reeds, who was looking for someone who had capital markets and risk management experience to make sure that Ledn was doing things in the right way to protect their clients' assets. By that time, I had become very interested in Bitcoin. I bought my first Bitcoin in 2019, so I was late to the show. But let's face it, I'm an older guy. We take a little bit longer to figure things out. And so I thought it was a really interesting opportunity to take everything that I'd learned in the capital market space at banks. And banks are very bad at a lot of things, but they're very good at risk management. And so to take a lot of that risk management experience and also some of the product experience that existed in TradFi that doesn't exist or didn't exist at the time in the digital asset space and bring some of that over. So I was really excited to join Ledn. It was funny. A lot of my colleagues from the banking world were like, why would you do this? This doesn't make any sense. This is bullshit. It won't be around in a couple of years' time. And that actually strengthened my resolve to do this because it seemed very evident to me that there was so many inefficiencies because the experienced people from TradFi had not yet come into the space, that there was going to be a lot of value add that I could bring, and also that it would kind of elevate Ledn's security posture well above their competitors, which proved out to be true. What we saw in 2022 and 2023 with the credit issues that faced the space that resulted in BlockFi and Voyager and Celsius all going bankrupt. Ledn avoided all of that because of all of the risk management procedures and policies that we put in place at that time.
Following up on that, like what are some of the things that when that was going down, when obviously FTX is this crazy, outlier on everything that they're doing, but even like a Celsius, or a BlockFi, something that's maybe more towards the middle on the curve on how crypto companies were operating at that time. What were some of the things you're like, why were they doing that? What were their books? This doesn't make any sense from like the CIO role.
Well, I certainly had a lot of those discussions. I remember very distinctly, this is in 2022, we had a board meeting and one of the board members said, why are our competitors like BlockFi and Celsius so much bigger than we are, growing so much faster than we are? And I looked at them and said, okay, there's two reasons. One, they support every digital asset going, and we're focused on Bitcoin alone. So they're going to be bigger than us just because they've got more market penetration. Although we didn't want to get into that space for reasons I'll talk about. And then the second reason is I have no idea how they can be growing as fast as they are and have as much exposure as they do without taking on a huge amount of risk with either their own investors' assets or their clients' assets. And we had this kind of debate about whether or not I was the right guy for the job since I wasn't willing to do what they were doing to grow faster. And what they were doing, Celsius was a great example of this. They were offering yield on every single coin that had been minted, even though there was no way to generate yield on any of those coins without swapping them into something else, taking that risk that you couldn't hedge, and then swapping them into dollars and lending dollars, or swapping them into Bitcoin and lending out Bitcoin. But you couldn't hedge that risk that you had with the directional exposure. And they got badly hurt with that when everything started going down towards zero. And then the other thing they were doing is they didn't have any risk management procedures or policies around the credit underwriting they were doing for people like 3 Hours Capital. 3 Hours came to me 4 separate occasions asking to borrow uncollateralized funds. And I said, well, sure, let us do proper credit underwriting. Send me all of your financial statements. Well, they didn't share financial statements. And I said, well, we won't lend to you unless we can see financials. And they said, but we'll share an attestation of our assets under management. I go, yeah, I don't give a shit. I want to see your financials, because that means nothing to me that you've signed this piece of paper saying we've got $10 billion in AUM, because I have no idea what your net equity is. I have no idea whether any of those assets are yours. And so they kept saying to me, you're the only ones who don't lend to us in the space. And I kept thinking, we're going to be the only ones left standing when this all blows up. And it was less than later that all happened. So it really was, putting in the risk management, proper underwriting, proper credit underwriting, making sure that we weren't doing things with our clients' assets that they were unaware of. I think it's fine if you swap out clients' assets, if they want you to do that, if they want you to take that risk. But Celsius wasn't telling their clients they were doing that. They weren't transparent about what they were doing. And so we believe in transparency. We believe in protecting our clients' assets, and we put the client at the beginning. All the decisions that we make are client focused. And that's why we're around when they're not.
Yeah, I mean, my background, Jody's background, where we were at one point in our career at a custodian, I can share a little of what you're talking about here when it comes to looking at the risk, looking at the financials of these companies. Literally would go to some of these firms when they would come to want to work with us. They would say, you'd be like, all right, we need to see, they want to do liquidity or whatever. They want us to give them various financing options and things of that nature. When you ask them for financials, it's like you ask for something completely foreign. And, you look back now and that whole time period, like you talked about 2021, 2022, it turns into a blur because there's just so much going on. And it was, I'm going to miss out on that run. I'm going to, I didn't buy early enough. Well, did you? I mean, look at now. I mean, so very interesting how you were able to see that out. One of those clients, I'm not going to mention which one, was a customer of ours, not once, but twice. And so they were gone twice because of issues. So
Yeah.
there you have it.
Yeah. And
but
I'm a little worried that we're starting to see some of that behavior again. When everything was frothy and you were really afraid of missing opportunities, people were willing to cut corners and take some risks that maybe they wouldn't otherwise in order to grow quickly. I'm starting to see some of that again. Like in our space, we see some people who are now, offering to lend in CFI, lending at 8% or below. Well, funding rates are 8% or above. So either they're doing this for free or they're doing it at a loss or they're taking big risks to do it. And I believe that they are starting to take some big risks to do it again. Now that worries me that we're going to see this play out again at some point.
I know exactly where you're going with this because some, having been in capital markets and electronic trading, and you come from the electronic trading side too, it was always the race to zero. And how fast can we get the fees down? How fast can we, if we bring the fees down, it's going to open up the floodgates to everyone and everyone's going to use it. We're all going to sing Kumbaya. The problem is that's not always good. Like you don't always want to bring those fees to zero because, look at the equities market. You're now trading in mills, like sub mills in fees. But to your point, there is, because I did some research on this recently, there is a huge gap. Like the top side of the market is like 14, 15% interest. The bottom side comes down to like, I think it's like 7, a little under 7, or, 6 and some change. To your point though, that's a huge spread. And so the question is, how is one offsetting? I understand people want to get adoption in the market and things like that, but you're not going to go put up capital to get like 2% return. If Fed funds right now is 4.33, like around there, between 4.25, 4.5. You're not going to do all of this just to get 2% return, I don't think. I don't know. I'd love to.
Well, certainly not in the retail space.
It's too risky.
You wouldn't do it in the retail space. Maybe some wholesalers could make some profits in doing it that way. The retail space, running a business like this is not inexpensive. We've got clients in 125 countries around the world, so that's 125 different jurisdictions. We've got 200,000 registered clients, so our customer service team is going 24/7 nonstop. None of that stuff comes for free. So I would personally rather deal with a company that I know is profitable and is going to be around tomorrow than a company that is buying market share by having zero profitability or running at losses in the hopes that they can somehow monetize that in the future and maybe they'll be around. So yeah, I don't know. Some of the people who we compete with, I worry about what they're doing.
Yeah, I think those days that was the whole mantra back in that 2021, 22. It's like, oh, we'll go raise 160 million. Don't mind that we're burning 5 million a month, but we'll get there. And it's like, let's just say you're going to put $1 million with someone burning 5 mil a month. That at the time it was like, oh, heck yeah, we'll do it. Now you look back, you're like, why did I ever do that?
It's funny when I think of the conversations that we had with potential VC investors and then private equity investors and the conversations we're having now with people who want to invest in us. One of the key questions we are always asked is, what's your runway? Like, how much cash do you have in terms of months. And we would always say, I don't even understand the question. We're profitable. So
Right.
our runway is infinite. So if you're asking the competitors how long before they shut the doors and run out of money, why are you putting money with them? I don't really understand.
Especially when you're
And
parking
a lot of
your
those conversations now anymore, no one asks about runway,
yeah.
which is
Especially
good.
when you're parking your crypto. Like if I have to put my crypto somewhere, there's no way. Like if they say to me, "Oh, we have 12 months runway," bye. That's the end
Yeah,
of that conversation.
exactly. And it's 12 months today. You have no idea if they're going to take on some big capital project and it's 2 months tomorrow, So, yeah, not a great investment thesis, but it is, the market's matured, which is nice. And, everything happens so rapidly in digital assets that it's matured in the last 2 years. Same thing that took, 20 years in TradFi to get to when they first started out. But, yeah, it's a healthier environment. But as I said, there are still some people who are, don't have the proper experience or are just assuming that crypto is going to go straight to the moon and we won't have another catastrophic event or we won't have any kind of massive correction. And,
Yeah.
those people will pay the price.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, now you can with Blockware. New tax guidelines from the Big Beautiful Bill will allow American miners to write off 100% of the cost of their mining hardware for a single tax year. That's right, 100%. Blockware's mining as a service allows you to do everything from securing the miners to sourcing low cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day while also saving for the upcoming tax season. Get started today by going to mining.blockwaresolutions.com/TBE. Again, that's mining.blockwaresolutions.com/TBE. Now back to the interview.
What would you say is, you mentioned, there's some providers doing like 8% and you're like, they're not making money or they're, seeking out yield in risky ways, just like a BlockFi or Celsius. We've seen like Coinbase and Morpho, very attractive, I think, interest rates, but then also the base chain went down, was it a week or two ago? And so for 30 minutes, so which is a big risk you don't have with, when you're just dealing with Bitcoin. What are some things that potential Bitcoin like borrowers or lenders should be looking at right now?
Well, I think certainly the borrowers on the retail side, your biggest question should be what's happening with my collateral that I'm posting to you guys? Like, where is it sitting? What are you doing with it? There was a time not that long ago where everybody rehypothecated, and rehypothecation was kind of the big buzzword that everyone's concerned about. And the rehypothecation was at the time utilized to bring lending rates down. So for those who don't know what rehypothecation is, it's taking that collateral and being able to lend that out. And so the money you earn to lend that out reduces the rates that you lend your dollars out that are backed by the Bitcoin. That was also always a risk because the way that the Bitcoin lending market on the institution side developed and is still the case is that those institutions borrow uncollateralized. So you're taking absolutely 100% credit risk to these institutions. We were involved in that space for a long time. We only dealt with the biggest institutions. It wasn't problematic for us, but it was problematic for our clients. And it was, it was never something that we were super comfortable in doing, but it was demanded by the clients in order to keep rates down. We've now been able to, with the entrance of more traditional financial liquidity providers on the funding side, been able to have great relationships where we no longer have to rely on any institutional lending of our clients' assets. So we don't do that anymore. We don't rehypothecate client assets anymore. And so the client's assets are absolutely safe. They're held in trust in Ledn's name, or they're held at a qualified custodian under a tri-party agreement. That's what retail borrowers should find out, what's happening to their assets. And there are other lenders like ourselves that do the same thing. Those are the lenders you want to deal with. Anyone who's lending out your collateral, you should be very concerned about. So that's one of the big questions. The other question that they should really be asking themselves is, has this company that I'm entrusting my assets with survived a big event? And therefore, can they likely do it again in the future? So, I would ask the company that I'm borrowing from, were they around during 2022, 2023? Did they survive it? How did they survive it? There is one of the lenders out there that did survive, but they suffered a massive loss and they forced their clients to convert that loss into equity in the firm. So, it was a forced investment that most clients wouldn't have wanted to make. But most of the other lending firms that are out there on the retail side now have only been around for a year. So they don't really have that experience. So you don't know whether they're set up from a risk management perspective to be able to weather a storm like we had back in 2023. So those are the two key questions that I would ask. What happens to my assets? And are you guys positioned for a downturn in the digital asset space?
No, I couldn't agree more. With regards to that, Ledn, you offer the B2, I think it's a B2X loan.
B2X, yeah.
How does that work? What are you seeing, in terms of demand on that? Is that, because that's more of what, like a leverage type product?
Before you answer, I did meet a guy that's an airline pilot at a bar in Hong Kong last week who has a B2X loan. And I was like, oh, that's he was just coming into town for the Bitcoin Asia conference, but it's quite a ways for a US based guy to come in.
No,
so
it's free.
Yeah. So
Exactly.
he was talking about it a little bit, but John,
I love hearing that. Well, the genesis of the B2X product, well, let me tell you what the product is first. So when a client wants to borrow from Ledn, they post collateral with us. All of our loans are done at a 50% LTV, so they have to post double the value of collateral to what they want to borrow. So if they want to borrow $10,000, they've got to post $20,000 with Bitcoin. What we were seeing was that a lot of clients were posting the collateral, taking the dollars, taking it off our platform, and then coming back with more Bitcoin onto the platform. So they were going somewhere else to buy it and bring it back. And we thought, well, that's a two-stage process. It is unnecessary. So what we do in the creation of B2X is a client will post $10,000 worth of Bitcoin. We'll give them a $10,000 loan. We'll use that loan to buy $10,000 worth of Bitcoin, which then becomes part of their collateral. So they're still at a 50% LTV, but it's all done in one transaction. And then, it allows them to gain leverage. So they're doubling the amount of Bitcoin they have. And when Bitcoin hits a price that they're happy with, then they pay back the loan, they sell the Bitcoin, or they just pay back the dollars, and they've made their capital gain on the Bitcoin that they were hoping for. So it's people who are looking for Bitcoin appreciation. And to your point on, how's that product going? It's a very, very popular product with us, but it is kind of dependent on people's viewpoint on what's happening with Bitcoin. So we tend to see a very strong uptake of B2X when Bitcoin is trending higher, is in a nice kind of non-correcting trend, or we see it when Bitcoin has dips. We don't see a lot as it's dipping, but when it kind of bottoms out like it is now. So we saw the dip down from 124,000 to where we are now. Now we're starting to see a lot of people take up Bitcoin or B2Xs again because they're expecting the next move higher to be coming. So it's a really popular product for us.
Not predicting the market there.
Not me. Although I do put out a piece every Friday predicting the market, but only from my own personal viewpoint. It has, this is not investment advice in any way.
I love it.
Yeah. Give us the link to that. We'll drop it in the show notes.
Okay. Yeah, we'll do.
Absolutely. Obviously, John, we had limited time today, but what I wanted to do before we wrap up, those looking to get into lending, borrowing, what are some tips you would tell people, things of that nature?
One thing I would say, because, the way that all of the retail lending side works is, as I mentioned, we start at 50% LTV. When Bitcoin price sells off and your LTV hits 70%, that means your collateral value is dropping. We send an automated notification out to our clients saying, hey, this is getting close to your liquidation level. You might want to add more collateral or reduce your loan amount. And we do that again at 75% because we just don't want people to be in a position they don't intend to be in. And that at 80%, they will get liquidated automatically. And that protects our investors and our clients from losing money. I would say don't take a larger size loan than you can afford to add collateral to. So if you only have one Bitcoin, I wouldn't borrow against that full one Bitcoin, because if Bitcoin prices come off and you don't want to sell that Bitcoin, which is why you borrowed against it instead of selling it in the first place to get dollars, you're going to have to post more collateral, or you're going to have to pay down your loan. So make sure you've got some bandwidth to be able to do that. And what we see with our client base, and we've got, I can't remember how many loans we have outstanding right now. It's like 20,000 loans. our clients tend to, when they get that 70% notice, they tend to add more Bitcoin. We have very low liquidations, even when there's big sell-offs in Bitcoin, because our clients tend to top up. Put yourself in that position where you're going to be able to top up that collateral. That'd be a recommendation for me.
Good advice. I think a lot of people don't think about that. They think about, oh, here's the good, and Jody, you and I have talked about this, but these are the good times. They all of a sudden forget about, the drop of 30 grand in a matter of weeks. So
Yeah,
definitely.
Yeah, and you and I have been in capital markets for long enough. We know nothing goes straight up, right? Everything has corrections, and we've been in a really great bull market. The question is, how long does that last, and what happens when we're in a bear market? Because we will be in a bear market at some point. Nothing just goes to the moon.
Yeah, that's the big question right now. Separately, you guys rolled out proof of reserves pretty early on. And this year, it's been more topical in the news because people have asked, like Michael Saylor, hey, can you do proof of reserves for your holdings at Strategy? And he's made some points where he said, look, I don't want to move the market, just in the same way that the 80,000, Bitcoin that was moved by Galaxy certainly dropped the market. He's like, if I move a single Bitcoin, it's going to do much more damage to that in a very short time period. What's your take as you're in a different position as a lender, but then you see other people in the space and you come from Barclays and TD Securities where you do need to trust public auditors, but Bitcoiners have a different view of viewing things on chain.
Yeah, I want as much transparency as is absolutely possible. And you're right. You have to be careful sometimes of giving people what they want because they may not really understand it or they may not know how to interpret it, which is kind of an issue. But if we could just say, here's where every single Bitcoin that's been posted as collateral with us resides, I would happily do that. Some things restrict us from doing that, like NDAs with some of our counterparties that we borrow from, because we've got to borrow the dollars that we're lending out and we post collateral against that. But we're big believers in providing as much transparency to our clients as possible. And we started off with semi-annual proof of reserves attestation that we did with an accounting firm. We now have a monthly open book report that shows where everything is. We want to get that to real time, and that's our goal, to get that to real time. So yeah, my view is if you're, especially on the retail side, you need to know what's going on behind the curtain. So you need that transparency, and we try to provide as much as we possibly can, and we'll continue iterating to improve that where we can.
Yeah, I think that's great. I think that's where the industry is headed on that transparency. Obviously, that's why we started 21 Rates and everything we're doing across the board. We saw it was spread so thin in the market, you couldn't find a good place to get information. It starts with lending. It starts with understanding. I had a 70-year-old dad. He's like, where do I buy Bitcoin? And, I can go to Coinbase, and I'm like, you can. That's a great starting point, but depends on what you're looking to do. Everybody's got a different taste of what they want to do, but having that transparency is key.
Yeah, agreed.
So
yeah. But John, appreciate you coming on. It's been good to chat with you, and especially as we somehow, at some time go into a bear market, which we don't love to talk about. It's good to have a sobering, conservative approach to how you're holding your Bitcoin to make sure that you hold all of it, throughout the bear market. So we'll have to have you back on and do a little personal finance checkup with the weekly CIO memo.
Yeah, absolutely love to. And, it's my wife always says I'm the oldest guy in digital asset space. She says I put the crypt in crypto, and having all of that experience and that, that scar tissue is because you do understand that bear markets do happen. I've experienced so many of them over my kind of 35-year career in banking and in crypto. You just have to be prepared for them and make sure you understand what exposure you truly have. Because as you said, you want to hang on to your crypto during those periods, and you want to add to it during those periods. And just, you want to make sure you're in a position where you'll be able to do that. So just don't, I have this conversation with a lot of young people in the space a lot. Don't assume that Bitcoin's going to $1 million next year and it can't go down to 50,000 first, because either one of those things can happen. One is more likely than the other next year. And it's not the $1 million in my view.
For sure. John, thanks for coming on. We'll get you back on. Definitely send over that newsletter. We'll share it with the group. But this was fantastic.
Appreciate it. Thanks very much, guys.
Yeah.
Thank
You're
you.
gone.
Bye-bye.